Kanka, today we're going to have the most important financial conversation of your life. Sit down, pour yourself a tea, put your phone aside, and listen to me. Because what I'm about to tell you will make you say either, I wish I had listened, or I'm so glad I listened 10 years from now. I'm a retired financier. I spent years running and operating car manufacturing factories, managing production lines, organizing million-dollar operations. When I retired, I had serious wealth in my hands because I always put the money I earned in the right places at the right times. Now I share that experience, that knowledge at seminars. Why? Because, Kanka, I can't keep this knowledge just to myself. If you learn something and don't share it, that knowledge dies with you. I don't want that. Now I want to start our video with this story. March of 2009. The S&P 500 closes at 676 points. The financial world is in complete freefall. Lehman Brothers collapsed 6 months ago. Half of people's retirement savings have been wiped out. Newspapers, televisions, everywhere is saying the worst economic crisis since the Great Depression. Everyone was trembling with fear, Kanka. Everyone. Right at that time, let's call her Elena. I had an architect friend. This woman took the $50,000 she had been saving to buy a house and invested it in an S&P 500 index fund. Her friends thought she was crazy. Her family did everything to make her give up, saying, wait, let the market stabilize, then invest. Elena didn't listen to any of them. Do you know how much that $50,000 became today, my friend? Approximately $600,000. She didn't pick a single stock. She didn't time the market perfectly. She had no inside information whatsoever. She simply recognized that moment that comes once, maybe twice in a generation. That period when those who turn fear into opportunity win, my friend. That perfect time that turns ordinary people into millionaires. And, Kanka, we are living through such a moment right now. But this time it's not a market crash. Something stronger, longer lasting, deeper. A time when forces that come together once in nearly a century align. During these times, we can say it will distribute more wealth to ordinary people than any event in American history in the simplest terms. The number is this: $124 trillion. Yes, you heard right. $124 trillion. This will change hands over the next 20 years, and the vast majority of people have no idea it's happening. Today, I'm going to tell you exactly what is happening. I'm going to explain why these conditions overlap with events that previously created millions of new millionaires. And I'm going to share with you the concrete steps ordinary people are taking right now to position themselves on the receiving end of this historic transfer. Let's first look at what happened after 2009, because that story perfectly illustrates how ordinary people created extraordinary wealth. The S&P 500 didn't just recover from the 2009 bottom, Kanka. It launched into the longest bull market in American history. From March 2009 to January 2026, the market rose over 900%. The index recently crossed 7,000 points for the first time. $100 invested at the bottom rose to approximately $1,000. But the ones who benefited most from this weren't Wall Street investors, weren't hedge fund managers. They were teachers, nurses, accountants, people with small businesses, ordinary people who kept investing in their 401s and IRAs while everyone else was panicking. Looking at the numbers reveals an incredible story, Kanka. In 2010, there were approximately 8.4 million millionaire households in America. By the end of 2024, this number nearly tripled, reaching approximately 24 million. The country added more than 15 million new millionaire households in just 14 years. Think about that. 15 million households crossed the $1 million threshold in less than a decade and a half. This is roughly equivalent to the entire population of the New York metropolitan area. And who were the vast majority of these new millionaires? Do you know, Kanka? They weren't entrepreneurs who sold companies. They weren't executives with stock options. They were ordinary people who participated in the market's rise through retirement accounts and index funds. Looking at the UBS Global Wealth Report published in 2025, America alone produced 379,000 new millionaires in 2024, more than 1,200 new millionaires every single day. And the vast majority of them reached millionaire status not through dramatic windfalls, but through the steady accumulation of assets in rising markets. UBS calls these everyday millionaires, people with a net worth between $1 and $5 million. This group has quadrupled globally since 2000, and a number of approximately 52 million people has emerged. They collectively control over $17 trillion in wealth. The path to joining this group is no secret, Conca. It's documented, it's repeatable, and it's about to get even easier. Now let's get to the main subject, to what makes the current moment even more important than 2009. They call this the Great Wealth Transfer. According to Cerulli Associates' latest 2025 research, approximately $124 trillion in assets will have changed hands between now and 2048. This is the greatest distribution of wealth in human history. Nothing close to this has been found in recorded economic history. To better picture that number in your head, think about this. $124 trillion is more than the sum total of every country in the world's annual economic output, several times more than the current U.S. national debt. 80 years of wealth accumulated in American economic expansion, waiting to be transferred between generations. The mechanics are simple, but the consequences are quite significant. Baby boomers, that is, those born between 1946 and 1964, Conca, these guys currently control approximately 52% of all wealth in America, meaning we can practically say these guys are the real owners of America, Conca. That's roughly $78 trillion concentrated in a single generation. The youngest boomers are turning 62 this year. The oldest are approaching 80. Over the next 2 decades, this wealth will go to their children, their grandchildren, and charities. Cerulli estimates that approximately $16 trillion will go to heirs, and the remaining $18 trillion will be donated to charitable organizations. Generation X will inherit approximately $39 trillion over the next 25 years. Millennials will receive approximately $46 trillion. Even Gen Z will start receiving significant inheritances as the transfer accelerates through the 2030s and 2040s. Timing is extremely important, Conca. Generation X, often called the forgotten generation, this group will receive approximately $1.4 trillion per year over the next decade. This coincides with a critical life stage where many are caring for aging parents while also supporting their own children. For this generation, the inheritance wave could transform retirement prospects that currently look uncertain. Millennials will wait longer, but will eventually catch a bigger tailwind. The $46 trillion heading their way will arrive as many are entering their peak earning years, and inherited capital will create a compounding growth environment alongside career income. But the detail that most coverage currently overlooks is this. The opportunity isn't just about inheritance. It's about the ripple effects that the movement of large amounts of money creates throughout the entire economy, my friend. When $124 trillion changes hands, it doesn't sit still, Conca. This money turns into investment. Spending happens. It flows into businesses, real estate, and the market. Every dollar that moves creates opportunities for people positioned to capture a piece of that movement. The last time something similar happened was after World War II. Returning soldiers used the GI Bill to buy themselves homes, started businesses, and built the middle class that defined American prosperity for half a century. That wealth creation event is what gave birth to the baby boomers, and now they are sharing their wealth. We're watching history repeat itself, Conca, but at a scale that dwarfs everything that came before. The parallels to 2009 run much deeper than most people recognize. In 2009, those 3 most important conditions that created extraordinary wealth for those who recognized the moment came together. Assets were dramatically undervalued after stocks had fallen 57% from their peak. Large amounts of capital were being pumped in through government stimulus and quantitative easing. And most people were either too frightened or too impoverished. They weren't in a position to take advantage. The current moment shares similar characteristics, even though the mechanism is in a completely different position. While markets haven't completely collapsed, wealth transfers will produce both opportunities and dislocations. Some assets will change hands to settle estates. Others will be redistributed by heirs with different investment preferences. This movement creates great buying opportunities for prepared investors throughout the transfer period. The capital injection isn't coming from government this time, Conca. It's coming from the wealthiest generation in history, the generation passing their wealth to their children. The scale, $124 trillion, exceeds any government initiative ever attempted. For context, Conca, the entire pandemic relief effort totaled approximately $5 trillion. The wealth transfer represents exactly 25 times that amount entering the economy over the next 2 decades. And just like 2009, most people have no idea about this. The great wealth transfer, despite its impact being far greater over the next 20 years, contains only a tiny fraction of the attention given to daily market movements. Do you think those who became millionaires after 2009 were smarter than everyone else? No, my friend, they weren't. They were simply alert people who were in the right position when opportunity arrived. The same principle applies right now. Capturing this opportunity requires understanding just a few key dynamics, my friend. I'm going to share these with you one by one, Conca, because this is what I always talk about in my seminars. Knowledge is power, but only when we apply it correctly. The first dynamic is this: inheritances alone won't create most new millionaires. This seems counterintuitive given the headline numbers, but the mathematics reveals the truth. It's not very difficult to estimate that approximately 62% of the wealth being transferred will come from high and ultra-high net worth households, according to Cerulli. These represent only about 2% of all households. The wealth transfer is highly concentrated. A small number of families will inherit large amounts. Most families will receive more modest amounts, or nothing at all. This is why relying solely on inheritance can be a weak path for building wealth. Most people won't receive life-changing inheritances. What they will receive is exposure to an economy supercharged by $124 trillion in moving capital. The opportunity isn't in the inheritance itself, Conca. What the movement of money does to asset prices, business opportunities, and economic conditions, that's the real issue. Think about the ripple effects. When trillions flow into investment accounts, asset prices rise and everyone already invested benefits. When heirs buy homes, real estate values increase and existing homeowners benefit. When inherited capital finances new businesses, job creation accelerates and workers across the economy benefit. The wealth transfer creates rising tides across multiple asset classes simultaneously. Second dynamic, understanding where the money will flow is extremely important. Research from Bank of America and Merrill Lynch shows that younger investors have dramatically different preferences than baby boomers. According to their studies, 72% of investors between ages 21 and 43 believe it's no longer possible to achieve above-average returns solely with traditional stocks and bonds. This represents a generational shift in investment philosophy that will redirect trillions of dollars. While baby boomers preferred blue-chip stocks and bonds, their heirs show a stronger inclination toward alternative investments, direct company investments, and new asset classes. Sectors aligned with younger investors' preferences will see massive capital inflows over the coming decades. Artificial intelligence infrastructure is already generating enormous investments in 2026, with companies like NVIDIA managing market returns. Clean energy, healthcare innovation, and digital assets are preparing to attract disproportionate shares of redirected wealth. This doesn't mean abandoning traditional investments, Conca. It means understanding that capital flows are shifting and positioning accordingly. Sectors that attracted boomer capital may underperform relative to sectors attracting millennial and Gen Z capital. Third dynamic, real estate positioning will be critically important throughout the transfer period. The great wealth transfer will reshape housing markets in ways that vary dramatically by location. Demand will increase as wealthier heirs want to buy homes. Supply will also increase as inherited properties enter the market. Markets where boomers concentrated, particularly suburban areas and retirement destinations, may see inventory increases that moderate prices. Markets where younger generations want to live may face intensified competition as newly wealthy millennials pursue home ownership. The data already shows this divergence, Conca. Median home prices have risen over 150% since 2000, but this appreciation has been highly uneven. Markets attracting young workers and technology investment are far ahead of markets losing population. $500,000 deployed in Austin versus $500,000 deployed in Cleveland will produce dramatically different results over the next 2 decades. Geographic awareness is directly related to wealth accumulation. Fourth, and perhaps the most important dynamic, staying invested throughout the transition period continues to be the most reliable strategy. The teacher Aishi, who invested $50,000 at the 2009 market bottom, didn't need complex strategies. She needed 2 things: capital to deploy and the discipline to stay invested through the subsequent volatility. The market has delivered an average annual return of approximately 10% over long periods. Someone who invested $500 per month in an S&P 500 index fund starting in 2009 would have accumulated over $250,000 by early 2026, not counting employer contributions. But that journey also contained terrifying moments when fear was at its highest conca. The 2011 European debt crisis, the 2013 government shutdown, the 2018 trade war, the 2020 pandemic crash, the 2022 bear market. At every point, headlines suggested the rally was ending. At every point, those who stayed invested captured the subsequent recovery. The great wealth transfer will create opportunities, but the most reliable wealth building approach continues to be consistent investment in broadly diversified assets over decades. The transfer simply adds tailwind to an already proven strategy. I want to share these things with you. Something people frequently overlook about wealth multiplication events is how they feel while they're happening. The period after 2009 didn't feel like a golden age while it was unfolding. Constant reasons for anxiety dominated headlines. Every crisis produced predictions indicating the rally was ending, yet the market continued to climb and rise. The S&P 500 crossed 2,000 in 2014, 3,000 in 2019, 4,000 in 2021, 5,000 in early 2024, 6,000 in late 2024, and 7,000 in January 2026. Those who stayed invested through the anxiety accumulated wealth. Those who repeatedly fled to safety missed the gains. Goldman Sachs research shows that the cost of missing just the 10 best days in the market since 2009 reduces returns from approximately 17% annually to approximately 12% annually. Missing the best 25 days cuts returns nearly in half. The best days most often occur during the most volatile periods when fear is highest. The same pattern will characterize the great wealth transfer. Recessions, corrections, and crises will punctuate the transfer period. Headlines will regularly suggest that this time is different, that the old rules no longer apply. History suggests that these echoes will be proven premature just as they were after 2009. The underlying force, $124 trillion seeking productive deployment, will continue to present opportunity independent of short-term volatility. Now let's look at concrete numbers, Conca. Think about a 35-year-old today who invests $500 per month in diversified index funds for the next 25 years, roughly the duration of the transfer period. At the historical average return of 10%, that $150,000 in contributions turns into approximately $665,000. At a more conservative 7% return, it delivers approximately $405,000. The potential boost from the long tailwinds of the wealth transfer changes these projections meaningfully. If economic growth ran even just 1 percentage point above historical averages due to increased capital deployment, the 25-year outcome changes significantly. That 7% becomes 8%. The $405,000 rises to approximately $475,000. Increase the monthly contribution to $1,000, which becomes achievable for many as careers progress, and the numbers scale accordingly. At 10%, $665,000 turns into $1.33 million. Ordinary people reach millionaire status through consistency alone. These numbers might seem abstract, but Conca, they represent the difference between comfortable retirement and ongoing financial stress. The wealth transfer makes these outcomes more accessible for more people. Fifth dynamic, professions and businesses that benefit from wealth movement deserve attention. When $124 trillion changes hands, entire sectors grow to facilitate the transfer. Financial planning, estate administration, tax advisory, wealth management, and legal services will expand dramatically. Real estate transactions will accelerate. Trust and estate litigation will increase. People who develop skills in these areas will find solid employment and business opportunities throughout the transfer period. Wealth movement doesn't just benefit heirs, Conca. It benefits everyone who manages, protects, and uses that wealth. The numbers already reflect this shift. The share of millennial and Gen Z clients at high net worth focused financial firms rose from just 8% in 2021 to 25% by 2024. Advisors who understand younger clients' preferences are seizing business that will compound for decades as an opportunity. Sixth dynamic. The spousal transfer dynamic that precedes intergenerational transfers creates its own opportunities. Cerulli estimates that approximately $54 trillion will first pass to surviving spouses before eventually transferring to the next generation. Nearly $40 trillion of these spousal transfers will go to widowed women. This creates a large and growing market for financial services targeting women. Advisors, planners, and wealth managers who develop expertise serving women will succeed and capture significant business as women become the primary controllers of unprecedented wealth. The full intergenerational impact will unfold, not all at the same time, but over multiple decades. The transfer is a marathon, not a sprint. Those who position early are compounding advantages throughout the period. The timing question always comes up, Conca. People want to know when to invest, as if there's a perfect moment they're waiting for. The 2009 bottom seems obvious in retrospect, but at the time, nobody knew it was the bottom. The market could have fallen further. Many expected it would. The great wealth transfer doesn't have a bottom to time. It's a 25-year process that's already well underway. The oldest baby boomers are 79 years old in 2026. Transfers are happening right now. Waiting for a better entry point means missing years of compound growth while capital continues flowing. The best time to plant a tree was 20 years ago, Conca. The second best time is right now. The same logic applies to positioning for the wealth transfer. Now let's come to the action plan. An action framework based on this research should include several key elements. First, maximize tax-advantaged account contributions. The $124 trillion transfer will be partially captured by people whose retirement accounts grow alongside economic expansion. Max out your 401k. Max out your IRA. Use HSA if eligible. These accounts allow wealth to compound without annual tax drag. For 2026, the 401k contribution limit is $23,500. An additional $7,500 catch-up contribution is available for those 50 and older. Second, maintain exposure to broad equity markets. Don't try to pick which sectors will benefit most. Own the entire market through low-cost index funds. As the wealth transfer flows into various investments, broad market exposure ensures participation in aggregate growth. Third, develop skills that serve wealth movement through career pivots or side expertise. Understanding finance, estate planning, real estate, or wealth advisory creates opportunities to capture fees from capital in motion. Fourth, build cash reserves for opportunistic deployment. The wealth transfer will create moments of dislocation when assets are temporarily mispriced. Having capital available when others are forced to sell provides enhanced returns during periodic disruptions. Fifth, extend your time horizon. Think in decades rather than years. The transfer spans 25 years. Position accordingly. Short-term market movements matter far less than long-term participation. Sixth, consider geographic positioning. If flexibility about where you live exists, research where wealth will concentrate versus where it will disperse. Real estate in receiving markets may outperform significantly. And, last of all, Conca, have conversations within your family. Understanding family plans helps with financial planning. Whether you're in a position to potentially receive inheritance or leave wealth, it doesn't matter. Proper estate planning ensures efficient transfers. Historical context puts this moment in proper perspective. The United States has experienced a handful of wealth creation events that transformed ordinary people into millionaires on a massive scale. The post-Civil War industrial expansion created the first class of American millionaires. Their numbers were between 4,000 and 5,000 in 1900. The post-World War II boom created the first mass millionaire class through housing appreciation, stock market participation, and pension systems. The bull market running from 1982 to 2000 created millions more millionaires as 401ks expanded and technology stocks soared. The recovery from 2009 to 2026 nearly tripled the number of millionaire households as markets reached new highs. Each of these events produced millionaires who simply participated in economic expansion. No genius required, no insider access needed, just presence and patience. The great wealth transfer represents the next chapter, Conca. 124 trillion will move over 25 years. Economic activity will accelerate. Asset prices will be supported, opportunities and suggestions will emerge. The question is not whether the transfer will happen. It's already happening. The question is whether you'll be positioned to benefit. In 2009, AC didn't know she was capturing a once-in-a-generation opportunity. She simply recognized that fear had created value and acted. Today's opportunity is different in mechanism but similar in scale. Trillions of dollars are moving. Millions of new millionaires will be created. History will record this period as a defining wealth creation event. You now know it's happening, Conca. You know the scale. You know the timeline. You know the strategies that position ordinary people to benefit. What you do with that knowledge will determine whether you're among the millions who look back on this period as the moment everything changed. I hope that one day you too will be among those millions, Conca. Believing is half of achieving. See you, Conca.